Welcome to the Robert Hunt Financial Market Update. It's your host,
Robert Hunt,
where I look at the week's financial news that can be a bit confusing, misleading, and take you off course and help to make it actionable, understandable, and clear. You heard right. Back by popular demand is Bobby Hunt, whose real name is
Robert Hunt.
And so, in a sense, the Robert Hunt Financial Market Update is the Robert Hunt Financial Market Update, even with a guest today. So no name change required or needed. What a break we took, Bobby. We're gone for 2 weeks and the whole world changes. So we're back, and we got a lot of texts in our absence with confessions about people day trading and going into meme stocks and going all in on crypto. We're happy to report those were all false flags. Not a single legitimate apostasy from our listeners. Everyone stayed within orthodoxy and kept those costs low. They kept that investing
simple.
And they kept the time horizon long. So we're going to do our best to cut through what happened in our absence, but the show goes on. We've got really 3 great articles, kind of 2 articles and a tweet, but we are going to look at a Wall Street Journal article by James McIntosh, August 5th. Is this 1987 all over again? What's driving the market meltdown? Ooh, big day on Monday. We then have another article called The 401k Investors Convinced That Target Date Funds Miss the Mark. Not all investors keep the default setting. And then we are going to close with a Mark Meredith tweet, if you even call it that anymore, on the X platform, and a reminder on why long-term matters. So for those of you who submitted articles that I'm not mentioning, please continue to submit. We had so many people submit articles this week, I actually wasn't able to incorporate them all. It's about a 17-minute show, guys, and the producers will not let me keep going past that, so they draw a hard line. Who are my producers, Bob? Who's in charge over here?
You.
That's correct. So I am the producer. So, okay. Let's start here. Mr. James McIntosh, is this 1987 all over again? The article reads, financial markets are supposed to capture the wisdom of the crowd, but on Monday, it seems like an eternity to me already, the crowd ran in all directions. Japan's stock market fell the most in 37 years, with a 12% plunge that wiped out all its gains for the year. One day. Well, in the U.S., the VIX index, that's implied stock volatility, briefly had its biggest rise ever. Panic hit. I'll continue on. Later in the article, it said the sell-off, which at one point had chipmaker NVIDIA down 15%. Just to put that in perspective, that was a $3 trillion company, down 15%, was so big because investors had been all in, betting that things would work out well. Now things have calmed a bit. The question is whether the unwind of these bets and the leverage behind them is done. Now, this headline is analogizing 1987. So they talk about 1987's crash. They have 1998's long-term capital management blow-up, 2008's global financial crisis. But in 1987, for those of you who weren't around, Bobby, were you around in 1987?
No.
Where were you?
In my mom's room.
Well, that perhaps is an idea. That's as safe as bet as any, I suppose. But you were not here. I was only 2 years old. I don't recall what positions I had in the market at the time. But in 1987, the stock market had its biggest one-day fall ever. The S&P was down more than 20% on Black Monday. 20%. Investors had built up excessive leverage after a stunning 39% gain in the year.
Mama wasn't born yet.
Oh, that's quite possible, depending on, thank you, Bob, depending on the, thank you, Bob. So, as an investor, what I find instructive about these times is, were you able to be stoic during the panic? I think it's a great lesson, and I wish, perhaps if you have a journal or a diary, I think we always can think too highly of ourselves and how tough we are. But if on that Monday you could go back and write down exactly how you felt, I think that'd be instructive, because My suspicion is that folks were more worried than they let on. Weeks later, people will actually forget about this. Months later, it'll become a distant memory. But how did you fare? Did the long-term perspective that you've taken, was it enough? Or did you start believing these headlines? Because these headlines come at you. This headline's about, hey, is this 1987 all over again? Are you in big trouble? So, and then this article continues with all the various things that could go wrong. So this is why market declines that are quick like this are difficult, is because they don't happen in isolation. This doesn't happen in a vacuum. This accompanies a whole bunch of news, and there are a whole bunch of reasons why it happens. So, Bobby Hunt, do you remember where you were on Monday when the market crashed?
No.
And you don't care about the stock market crashing, do you?
No.
Do you watch financial news at all, Bob?
Sometimes.
Sometimes over my shoulder?
Yes.
Ah, you got me. Okay, but Bobby Hunt didn't worry one lick because he's taken a very light financial diet where he actually doesn't know what happened. And I think that's all to the good, because what I like to remind people of is, hey, if I were to look up and say, what is the year-to-date gain in the U.S. stock market? As of today, it's 11%, up 11%. Well, all right. Is that really so bad? Why are we mad about that? International stocks are up 4% year-to-date. Is this something to weep over? I don't think so. For the week, and I'm admittedly recording this on Thursday, for the week, the stock markets in the U.S. is down 0.68%. For the week, the international stock market is up 0.08%. So nothing has happened. Unless you were really dialed in on the volatility. You really wanted to make moves. You wanted to have your finger at the clicker. So the less we digest in the financial news, the better. Bobby Hunt had no idea, still doesn't know, still doesn't care, and therefore he is a superior investor as a result. Now, this article is related. This is tangential to the first article, headlined, 401k investors convinced that target date funds miss the mark. Not all investors keep the default setting of their retirement plans. Oh, dear. Okay, we have met the enemy, and it is us. So target date funds are a big deal, and they're becoming more popular, and I think that's a good thing. Target date funds, they explain this article by Ann Turgeson and Oyen Adedoyan, says these target date funds attract 64 cents of every dollar that flows into a 401k plans, according to the Vanguard Group. They are the default choice for millions of retirement savers who are automatically enrolled in 401k plans. Haha, this is funny, but like Taylor Swift or pizza, they also have haters. A lot of people shun them for a lot of reasons. One is that they cost more. Now, this is not true of all of them, but yeah, on average, target date funds cost 0.68% a year. To put that into a little perspective, that might be 22 times more expensive, roughly, than kind of one of your low cost index funds. So that's a lot more. But what happens is, and this is what happens in upward moving markets, people want to go risk on. So this article outlines various stories of investors who were originally in target date funds, again, which I like because they take us out of the cockpit and automate things and de-risk us appropriately as we retire. So by way of review, a target date fund starts aggressively, particularly, so if you say target date fund 2060, that means you expect to use the money in 2060. So the fund might start with 90% stocks and 10% bonds, but as you approach 2060, you might be in 50% stocks, 50% bonds, maybe a smattering of cash, etc. So it is automatically becoming more conservative as you approach your retirement date, or if it's for education, your education date. It does it for you. So I like them because it eliminates the biggest risk, which is you and I looking in the mirror, overthinking things, thinking we do things. It makes it so you don't have to change your asset allocation ever. You click it and you're done. These folks, though, wanted more. So there's a story of Brooke Hurley, who's 24. She moved all of her 401k money out of a targeted fund into low-cost index funds, which, hey, who likes those? But here's a problem. She thought that 10% bonds was too much. So she wants to be 100% equity allocation. Now, that's not the end of the world unless Miss Brooke Hurley, forgets about it or is bothered by the volatility or just hasn't been through. There are 10-year periods where stocks underperformed to bonds. So from the year 2000 to 2010, bonds outperformed by a lot to stocks. So what's tough is if you go through a decade where your particular asset class you go all in and does poorly, can you stick with it? I think most people cannot. This talks about an advisor, Stephen Kellio, saying that, wow, if you just go all stocks and historic returns hold, then you can make a whole lot more than target date funds. Well, duh. Hello. Yes, that's true. That ignores quite a bit of externalities. Like, we don't know what's going to happen in the next 20 years. It could be that bonds outperform. That's possible. There have been decades where they do. I think it's probable stocks. Well, what's most important is bonds will help you stick with it. You will actually make it through the difficulties that exist. Bobby Hunt's got something to say. All right, we're going to let him in studio. Yes, Bobby, go ahead.
What's about the podcast? Are you going to talk about Madden?
Oh, Bobby brings up a good point. Today was the drop of Madden 25 on mobile. So I'll find a way to bring it in, Bob. Maybe patience. We had to be patient to wait for Madden. So Bob and I, before school starts, been playing some video games. Okay, but these target date funds, what we have to realize is they protect us from ourselves. And there's no guarantee that your 100% stock allocation will actually outperform. So if someone told me, hey, Robert, I'll go 100% stocks and I'll change the allocations as needed over time, okay, that's fine. I've also done this where people's target date funds and their 401ks, they really are expensive. And then what we'll go through is we'll slice and dice. We'll say, all right, we'll use this index fund, that index fund, that bond index fund, and we'll kind of build our own target date fund. And I'll say every 5 years we have to rebalance because I do believe the savings are worth it. In these examples, and this article doesn't deride the target date fund. I think it makes way too much of a human being's ability to go in and out of markets and to adjust their asset allocation accordingly. I think it's way harder. And my experience has shown me that people forget about money. I forget about money. We have these dormant accounts that just kind of live on, and then you wake up one day and it's, your account could be down 20% in the year. And that happens. And you could be on the verge of retirement. You need the money and you didn't do a target date fund. You're in 100% stocks and then you're kind of nervous, and all that can be avoided with a handy dandy target date fund, which will change the allocation for you as you age to an appropriate level. I like them. Okay. And then we have a great tweet by Mr. Mark Meredith. This is funny. This is, I guess, that Monday when things were really bad in the market. The Japanese index dropped the most it's ever dropped in 37 years. So that's a lot. Okay, this is what he says. This is how people post on X when the market is down. If the market's down 5%, the doomsdayers, will say, this is only the beginning. When the market's down 10%, they will post a chart with an overlay of 1929, showing what will happen if we continue on our path. If we're down 20%, it says, if your advisor tells you to hold, fire them. If the market's down 30%, they begin quoting verses from Revelation. And he adds, these usually get deleted with the subsequent rally and recovery. Now, he said this Monday, so it's very prophetic because, as I referenced earlier, it appears like the market's back. Now, Bob, why do you think people start quoting from the book of Revelation, the Bible, when financial markets get really bad? Do you know?
No.
Well, here we go. What it can mean is, in the book of Revelation, it is prophetic for, depending on your views, what happened in 70 A.D. when Rome came in and sacked Jerusalem, or what you believe will happen in the latter days. So it's very dramatic language, Bob, that involves existential risk for those occupying those verses. So people will quote Revelation saying, this is the end. This is the end. This is it. Pack it up. Get your canned sardines out, which can last a decade, by the way, if you want to get some canned sardines. Get that canned food out because you're down 30%. What I am convinced of is that if the markets were to drop 30% and hang out there for like 2 years, incredible numbers of sellers would exist. Like, the toughest investor could be the person talking to you right now. I don't know. would potentially liquidate because of the pain, the absolute agony that exists to watch the market go down and keep going down is absolutely agonizing. My reference point for that would be 1929, where the market did not drop in 1 year. It kept dropping all the way to like 1931, like the middle of it. So you just had to watch year after year after year. Now, not as many Americans owned stock back then, but for those that did, it was virtually impossible. They just could not handle waking up in the morning, seeing their stocks lower, and they just wanted that emotional pain to stop. So let's have a right view of our own fragility and realize, hey, we might need to have a more conservative portfolio than we think. Mr. Morgan Housel, who wrote The Psychology of Money and who's one of our North Stars in terms of understanding human beings and money, he has an interesting personal application. He keeps 20% of all of his assets in cash at all times. Now, Warren Buffett disagrees. Warren Buffett says you don't need to hold any cash at all if you've got large multinational corporations, large companies, stock, you're fine. I like Housel. I think Housel's worked with enough people, and Buffett, I think, underestimates all of our shortcomings relative to his, where while I don't ascribe to that 20%, I don't think Housel's wrong. I think I might be wrong. I don't know. It's certainly is very conservative, but what it does is in great market turmoil, what Housel's done is he's done the research, and he's seen how many people have zeroed out their accounts because they couldn't handle the volatility. So let's have a right view of ourselves. And then in closing, I broke this chart out with clients this week. It is a 1801 to 2021 chart showing $1 invested in stocks, bonds, bills, gold, and the U.S. dollar. And it's logarithmic, and so it starts with $1. And what you see is $1 invested in stocks, and I've mentioned this on the podcast before, in 1801 equals 2.3 million. But what I ask the client to do is when I give them this chart, I say, all right, I want you to find 1929 on the chart. Find 1929. It's actually hard to do, even on a 200-year chart because it's logarithmic, meaning it goes from $1 to $10 to $100 to $1,000 to $10,000. It's actually hard to find the greatest stock market crash in U.S. history on a chart. The point being is whatever happened on Monday is going to be indiscernible on a long chart. So if the chart can't find it, we probably shouldn't care too much about it either. But what should we care about? We should care about keeping our
costs low, keep our investing simple, keep your time horizon long.
Well said, Bobby. Until next time.